Good evening, everyone. Alongside Susie Garib, I'm Tyler Matheson. Stocks sold off all around the globe today as jittery investors reacted sharply to the conflict between Russia and Ukraine. All three major U.S. indexes had their worst one-day slides in a month, taking a cue from those overseas markets. The buildup of Russian troops in Ukraine over the weekend sparked a stern condemnation from the White House.
What cannot be done is for Russia, with impunity, to put its soldiers on the ground and violate basic principles that are recognized around the world. And I think the strong condemnation that it's received from countries around the world indicates the degree to which Russia's on the wrong side of history on this.
As Russia tightened its grip on Ukraine's Crimea region, it was risk-off in the equity markets, with Russia's own stock market tumbling 12%, and Russia's central bank was forced to hike interest rates to keep the value of its falling ruble from plunging even more. Volatility spiked at exchanges around the globe as investors pulled money out of higher-risk stocks and switched cash into theoretically safer physical commodities. The price of gold hit a 4-month high. Crude oil shot up more than $2 a barrel, ending just shy of $105. The Dow was down as much as 250 points early in the session, but it battled back and ended just 153 points lower. The Nasdaq lost 30, and the S&P 500, which just reached an all-time closing high on Thursday, was down 13.
While the threat of military action heats up, officials in Ukraine's capital try to find a diplomatic solution to the standoff and to look for immediate relief for the country's growing financial crisis. Steve Sedgwick has more from Kiev.
On the ground here in Kiev, the Ukrainian capital, on Monday, the pro-Western government reiterated its support for a peaceful and negotiated solution to the current political crisis, which has seen Russian military occupation in the Crimea. I spoke to the Prime Minister of the Ukraine today, who said to me he was willing to rebase the relationship with Russia, but on the proviso that there was no more military action in the Crimea and indeed broader Ukraine territory. The second crisis in this country is a financial crisis, and indeed the economy minister admitted to me today that the coffers were essentially empty, that the country was down to its last $15 billion of international foreign exchange reserves. But he remained hopeful that with the IMF in town and due to begin negotiations on Tuesday, that a deal could be reached in 4 to 5 days. For Nightly Business Report, this is Steve Sedgwick in Kiev.
With Russia already suffering financially from its move into Ukraine, the threat of economic sanctions from the U.S. and perhaps from other nations as well could have an even more serious impact on Moscow. Our Steve Leisman takes a look now at what economic leverage the U.S. and its allies may have against Russia.
The U.S. has little economic pull to force Russia to give up Crimea, but some experts think it may not need it. The early conclusions that the fall of the pro-Russian Yanukovych government made Russian President Vladimir Putin look weak, and he invaded to respond to criticism inside the Kremlin and the country, and to have a card in the future course of Ukraine. But ultimately, experts say occupying the Crimea or any part of Ukraine is at odds with Putin's own best interests, and the best the West can do is help him figure that out. Former NSC Russian analyst Tom Graham, now at Kissinger Associates, says Russia for many decades has wanted a Ukraine that is not in Western orbit. Annexing Ukraine or any other part of the country forces what's left of Ukraine toward the West and creates a volatile country on Russia's doorstep.
The U.S. and the Western strategy is twofold. One, it's to put some pressures around the edges on Russia commercially and diplomatically, kick them out of the G8. Then you come in with an IMF program and with direct support to enable the Ukrainian government to solidify itself.
In addition to that, a senior administration official added, quote, "The other part of the strategy is to offer him a way out. At every juncture, there's an off-ramp for Russia if they choose to de-escalate." That means the best response could be a united Western political front that agrees ultimately to national elections for president and for parliament. If there is escalation, it could come in the form of trade sanctions, banking restrictions, and military and intelligence aid to Ukraine. But severe banking restrictions, such as those imposed on Iran and North Korea, would take a long time to work and would be much harder to unify the West around them. So options are limited and of potentially limited effect. The hope is that Russia decides on its own that holding Crimea is not in its interest. For Nightly Business Report, I'm Steve Leisman.
Well, despite the political turmoil in Ukraine, our guest tonight says the instability there will not weigh on the stock market here. He's Andres Garcia Amaya, global market strategist at JP Morgan Funds. Andres, nice to have you with us. Let me begin by just asking, why aren't you worried? And are you confident enough to tell and advise investors to buy on the dips?
So the first thing that I would say is that short term, I am worried, right? This situation is very fluid and it could escalate before it de-escalates. But if you're a long-term investor, right, if you're not trying to invest for the next week, but you're trying to invest for the next 3 years, next 5 years, we don't think that the issues in Ukraine are systemic for either the European economy or the U.S. economy. And that's our base case, right? And based on that assumption, we think that the U.S. equity market will be fine and European equities will be fine in the long term. The short term, sure, this is a risk-off environment and it might actually see more volatility over the next few weeks.
I assume, Andres, that Russia is included among the emerging markets and its stock market was down 12% or so today. If you're in a general emerging markets fund, you're going to feel it, though, aren't you?
Absolutely. I think short term, you'll see, you'll take a hit there and you probably will take a hit in the next couple of weeks. Having said that, this is also going to create some opportunities for long-term investors because not all of these countries that are put in the emerging market index are the same. For instance, India is in the emerging market index, is one of the countries that I favor at this point over the next 2 or 3 years, yet it was down 1.5%. Doesn't have a lot to do with Ukraine or Russia, their economy doesn't, yet it was down, right? So it should create some opportunities. You just need to be able to differentiate between the risk and the opportunity.
So what kind of investment changes should investors make? There's emerging markets, you just talked about that. A lot of investors have stock in big U.S. multinationals that have a lot of trade with Europe, which could be impacted by this Ukrainian situation. So what kind of investment moves should investors make in their portfolios?
So I think your strategic portfolio should not change based on the Ukrainian situation, right? If you sell now, then you have two tough decisions. One, did I make the right decision selling, and when do I have to re-enter the market, right? So for long-term investors, we still believe staying invested is the best avenue to go. Obviously, you need active management. You need people that understand what's happening on the grounds and make those tactical decisions. But when it comes to your long-term investment horizon, right, if you're trying to retire one day, the situation in Ukraine should not change your overall portfolio.
Talk to me about the commodities scenario. Gold up today, oil higher, nat gas has been on a roller coaster.
Yeah.
What's next?
Yeah, so one thing to note, because a lot of people are concerned about natural gas specifically, if you think about Ukraine, why it matters so much to Europe, is a conduit for them to get Russian natural gas, right? So the good news here is that Europe, unlike the United States, had a mild winter. They actually have a ton of inventory of natural gas, more than 20% than they usually do by this point. So natural gas in the short term could see a spike, but when it comes to actually supply constraints, Europe should be okay. And as we know here in the United States, we have a lot of natural gas that we're producing that we actually might end up exporting to Europe at one point if Russia continues to escalate the situation in Ukraine.
So, Andres, you heard our report from Steve Leisman, so it seems unlikely that there will be any kind of trade sanctions or banking restrictions. But what if? What if something like that does happen? What advice would you be giving investors?
The same advice that I mentioned earlier, right? This could get worse before it gets better. Very fluid situation. I can't really predict what the next 24, 48 hours will give you. But at the end of the day, if you think about the next 2 or 3 years and you think about your investments, this really shouldn't change the picture, right? And something that was mentioned earlier that I think is key, the pressure on Russia could come from the markets. Just to put this into perspective, it was mentioned earlier that Russian equities were down 12%. That's over $50 billion of market capitalization that is gone, right, overnight. That is more money that Russia spent in the Olympics, right? So this will put pressure on Putin, maybe not the U.S. directly through policy, but the markets at times put pressure on these type of situations as well.
All right, Andres, fascinating discussion. Thank you so much. Andres Garcia Amaya, he's Global Market Strategist at JP Morgan Funds.